Hello. I have just hit record. We're going to record this meeting just to let you guys all know. Thank you all so much for being here today. We're going to give it a couple more minutes just to make sure we get everybody. Everybody's so punctual today. I hope you're all having a great day. Hey, Sona.
Hey, Dana.
Hey, Stacy.
Hi, Dana.
Hello, Carol and Alicia and Lisa. Hello, Mary Ann.
Hello, you look
Disguising
very
herself
pretty.
as Carrie. Hi, Jenny. Hello, Caitlin.
Hello.
Hi, Jenny. I think I got to meet one of your kids yesterday, but I missed you. Did they give you your bag?
Yes. Yeah,
Okay,
thank you.
Awesome.
Record.
Hello, Malagra. All right. I am going to go ahead and get started because we want to keep it right at an hour. We want to honor your time. My name is Dana Fleming, and I'm the Executive Director of the Eugene Education Foundation, and I'm so glad that you are all here today. This is going to be a learning experience for me too, and so I'm selfishly offering this because I want to learn all about these things. But we're doing it this week because this week is National Estate Planning Awareness Week. So we're trying to be very apropos to the calendar. And I had learned a couple of months ago that 70% of adults do not have an up-to-date will or estate plan. And there are probably a lot of other financial things that follow suit as well. And so I think this is a very timely topic, no matter what age we are, where we are in life. And so that is why we're all here today. There's a couple of housekeeping things. You can post your questions in the chat, and both Jessica and I will be monitoring that. And then we will have a Q&A section at the end. If you think of anything to ask, we will be revisiting those questions so that Sarah and Sarah can answer those. If you can also try to mute yourself during the presentation, that will help. And it looks like everybody is such very good Zoom participants because everybody's already on mute. So I know you're here mostly to hear from Sarah and Sarah, but I wanted to run through a few things with you about EEF. And so I am going to share my screen. Fingers crossed it works. Okay, can you guys see our logo right now? Okay, and it's going to look like I'm not looking at you because I have two screens, and I'll be looking over at the side to make sure I'm on the right slide. So Eugene Education Foundation is the foundation for Eugene School District 4J, and we like to make connections. We take the support from caring people like you, and we connect them with programs that create opportunities in 4J that create opportunities for equity, access, and engagement for 4J students. We have an amazing board of directors, some of whom are here today, and some amazing ex officio members as well, who are employees with the school district. And we have a very tiny staff. This is it right here. Myself, Jessica Barnhart, who's our assistant director, and she is monitoring your questions, and Ryan Purnell, our operations administrator. And why do we care about education? I love this quote each of us must come to care about everyone else's children. The good life for our own children can be secured only if the good life is also secured for other people's children. And I think we found during the pandemic that really stood out a lot. A lot of folks got to see into the homes of students and see that some folks need an extra leg up. We'll talk about that a little bit later. These are some really good stats on investing in education and that it adds value to the communities. Jessica, I think 2 people are in the waiting room and I don't know how to let them in when the screen is being shared. But the number one thing that stands out to me in investing in education is that for every dollar spent on public education, home value is raised by 20. Isn't that crazy? But it really makes sense. And so, and then there's also this, the public benefit, the result of higher earnings of those with more education is direct in raising tax revenues and indirect in reducing reliance on public services. As you know, last 2 years looked a lot different than years prior. The hallways looked like this. Learning still happened though, and thanks to our supporters, we helped to make learning happen. And we're going to continue to support students and educators as they navigate this transition back to the in-person learning. Here's what it was like in the older years. We provided money to help students go to see the symphony and the beautiful Holt Center. We funded a really cool thing called Jogging Jags. You can see some of the students here have little lanyards. They could keep up with how often they ran, and they got all their wiggles out before they got into the classroom, and they actually focused better while they were in class. We've funded band instruments. These are some students at ATA. And during distance and hybrid learning, we kind of shifted how we did our grants. Rather than just once a year, we delayed applications, and we had 2 different application cycles. During that year, we gave over $120,000 to the schools and district-wide programs, and we also made it more a simpler process for teachers and administrators to apply by making them be able to apply via our website. And here are some of our funding categories from last year. We're going to talk a little bit about the social emotional support, but that was a pretty big chunk last year. And so we'll tie that back in just a second. And we had some success stories. We always do. And so, you know, some of the grants are kind of very technical, like styluses for middle school students, but it really helped them with their motor skills and using their Zooms. And then we also had some really neat ones where you never really think of this until it was requested, but the Echo High School, we helped purchase cap and gowns, and they have a young parents program. And so the students also got to get cap and gowns for their babies for the graduations. And so those pictures are so precious. And our priorities this year, equity, access, and engagement really fold into just about everything that we fund and everything that we do. This year, there's been an increase in the well, not just this year, over the years, there's been an increase in the number of grant applications to EEF that promote social emotional learning. This year especially, we're seeing that. And 4J is prioritizing mental health as students are returning to the classroom. We funded something called Conscious Discipline that helps students with emotional regulation, self-growth, and relationship building. And that's a pilot program that's being rolled out into the 12 Title I elementary schools. And this last sentence is so worth reading out loud. Psychological and physical safety underpins student success. And a lot of us don't think about that until we hear it. And then you think, oh, well, of course that makes sense. And this year more than ever, we're learning that is definitely the case. We've had a lot of community support. Since April of 2020, the community has given over $200,000 to the Student Needs Now Fund, which was created during the pandemic. And the donations have provided critical support to 4J families. And this is a photo of the food pantry that was created through that. We had some really great stories. We had Vanessa Vasquez, who's quoted here, was one of the 4J wraparound team members who distributes the Student Needs Now funds throughout the district. And just having that connection point throughout the pandemic was really important to parents, families. It made a real impact. Over 3,000 4J students and family members received food boxes, and over 320 4J families received internet connectivity. I see a typo, I'm so sorry. Over 125 4J students received clothing. They also had other connection points like Spanish cook-along classes for monolingual families. Desks and headphones were provided for students' homes to facilitate distance learning. And they even helped unhoused students with access to showers and Wi-Fi by giving them YMCA memberships. We also have rolled out a literacy initiative. Literacy is one of the big grant categories that we fund, but this is something extra that's a multi-year program that is targeted at grades K-3. We've done several different things to help quote unquote move the needle on literacy. And there is the support of district-wide supplemental phonemic curriculum. It's a mouthful, but it's a really great way to teach students to learn. It's very evidence-based and it's been very successful. We've given several free books to 4J students, and then we purchased licensing for an online reading program, which really helped during distance learning for teachers to track student participation and also show them where they were on their reading skills without them actually being tested. It just tracked it. We also gave a district-wide literacy grant last year called We E-Read, and you can see here in the light blue that how much reading immediately bumped up for students when those high-interest audiobooks were added to the queue. We also had a partnership with EEF, Connected Lane County Early Learning Alliance, and the United Way to provide books for students at River Road, Cesar Chavez, and McCornack and Howard. And then we had a very generous donor during the pandemic who gave $100,000 to support 4J students in elementary grades who've experienced severe trauma. And this is a program called Rosie's Fund, and it will help support some of our most vulnerable children. And here's how you can get involved. Donate, spread the word, encourage other schools to use EEF to assist with their fundraisers. We do help with site-based fundraising, and that is Jessica's purview, so she can set you up if you know somebody who's interested. And you can follow us on Facebook and Instagram and visit our website, eeflane.org. So that is just a really quick overview for EEF. And so now I'm going to turn it over to Sarah Kordon and we're going to let the Sarahs introduce themselves because it can get confusing. And we'll let her take over now with her presentation.
Thanks, Dana. That was really inspiring. Can everyone hear me okay and see the PowerPoint? Okay, excellent. Charitable giving is one of my favorite things to help people with. So I'm really excited to share some tips with you today. Before we jump in though, I do want to give you a brief overview of my background so that you have some confidence in what I'm telling you. I'm a certified financial planner with Merriman Wealth Management here in Eugene. The CFP designation tells you that I practice comprehensive financial planning. So unlike a stockbroker, I don't focus only on investments. I help people with really every area of their financial lives, including helping them plan for charitable giving goals. I'm also a charter retirement plan specialist. I have 19 years of experience, go Ducks, and last but not least, I am a 4J parent. So I also want to highlight for you, though, what I am not. So unlike the brilliant Sarah Subias, who's going to be talking after me, I'm not an attorney. I'm also not an accountant. And since this is not one-on-one discussion, none of what we review today should be taken as personal advice. Not all of these strategies are going to be right for everyone. We don't have time today to cover every restriction. And the tax laws continue to change. So it's important to work with your accountant, your estate planning attorney, and your financial planner on an ongoing basis. But I hope today's presentation will give you some great ideas on how you can be maximizing the impact of your donations, both for yourself and for the nonprofit that you're passionate about. Okay, so with that disclosure, let's dig in. So the first strategy is the most obvious and what most people end up doing, just giving cash or writing a check. The problem with this is that for many people, there's little to no federal tax advantage. Before I explain why, I want to take just a second to define a couple of tax terms that will come up a lot during my talk, just in case there are people listening in who are not familiar with them. So those two terms are standard tax deduction and itemizing. Every year, the IRS sets a standard deduction amount that every tax filer is able to claim regardless of your individual deductions. Examples of your deductions might be charitable contributions, property taxes, or mortgage interest. Some people end up having total deductions that exceed that standard deduction amount. And so those people itemize instead of taking the standard tax deduction. In 2018, the IRS actually doubled the standard deduction amount and then limited certain deductions that we used to be able to itemize, such as state income taxes, which is a big one for Oregonians. So many people who used to be able to itemize found themselves instead taking that standard deduction. This is significant because with one small exception, people taking the standard deduction will not actually save any money in federal taxes by giving cash. Depending on how you file and how old you are, the 2021 standard deduction is now between $12,550 for a single filer under age 65 and $27,800 for joint filers over the age of 65. If you aren't sure whether you are itemizing or taking the standard deduction, you can check with your accountant or look at the first page of your 1040 tax form on line 12. The small exception that I mentioned is that for 2021, single filers are able to deduct up to $300 and joint filers are able to deduct up to $600 for charitable donations while also taking that standard deduction. That's not expected to continue next year though. So let's talk about some other options that can save you on taxes and allow you to direct more dollars to the nonprofit. Once you reach age 72, you'll be required to start distributing a certain percentage from your pre-tax retirement accounts, such as IRAs and 401k plans. These required distributions are taxable as ordinary income unless they're given directly to a charity as what's called a qualified charitable distribution or a QCD. This is an excellent strategy for many people, even when giving smaller amounts. So by giving directly from your IRA, you eliminate taxes on the amount given, regardless of whether you itemize or take the standard deduction. Unlike other charitable deductions, QCDs also reduce your adjusted gross income or AGI. And this is important because your AGI is a factor in many other tax calculations. So reducing it can reduce your Social Security taxes and your Medicare premiums. It can also increase your medical expense deductions and help you qualify for certain other tax credits. So let's take a look at a hypothetical scenario to show you how this can be helpful. So this hypothetical Oregon couple wants to donate $10,000. They are 72 and they have an IRA, so they have a required minimum distribution. They take that money out of their IRA to donate. The distribution ends up pushing them into the 22% federal tax bracket. They're also in the 9% Oregon tax bracket. So they end up withdrawing $14,493 from their IRA in order to cover the donation that they want to make and the taxes. They pay that extra $4,493 in taxes. They donate the $10,000, but then they end up taking the standard deduction and they don't actually see a federal tax benefit. If they had instead done a QCD, they could have donated $10,000 directly from their IRA. No taxes would have been owed on the distribution. Only $10,000 would have come out of their IRA. They still get to take the standard deduction and it ends up reducing their AGI, so they might see other benefits as well. Okay, so now that we can see why this is beneficial, here are a few tips and tricks to be careful of. This can only be done with IRAs, but if you have another qualified retirement plan, such as a 401k, a 457, a 403b account, you can roll those accounts into an IRA in order to be able to do a QCD. You can donate up to $100,000 per person per year as a QCD, so you're not limited to the amount of your required minimum distribution. However, depending on what other assets you have, it could make sense to only give your up to the amount of your required minimum distribution as a QCD, and then utilize one of the other strategies that I'll discuss for other donations. Due to a recent change, you're not required to start distributing until age 72. However, as long as you're at least age 70 and a half, you can take advantage of the QCD rules. But again, if you're not required to take that distribution, so if you're between the age of 70 and a half and 72, then you're not necessarily avoiding taxation in that year. So there may be a better strategy to consider. However, anyone who has a beneficiary IRA or an inherited IRA may have RMDs at earlier ages and then want to start taking advantage of these QCDs at age 70 and a half. It's also really important to note that the company that holds your IRA account is still going to issue a 1099 tax document with the amount of the QCD listed as a taxable distribution. So you have to make sure that you're keeping really good records and to make sure that you tell your accountant about the QCD so that you don't end up paying taxes on it. If you tend to give every year and your itemized deductions are close to the standard deduction amount, clustering your contributions can increase your total tax deductions over a multiple year period. So for example, if you give $20,000 every year, you might instead give $40,000 this year and then nothing the following year. This would allow you to itemize in the year you donated the $40,000 and then take the standard deduction in the following year. So for a married couple in that particular situation, this could lead to an additional $15,000 of deductions over that 2-year period. This strategy can make a lot of sense for people who give regularly and take the standard deduction, or even people who might itemize, but their itemizations don't fully exceed the standard deduction by the amount of their charitable contributions. It can also be particularly useful if you have unusually high income one year from the sale of property, a business sale, a large bonus, vesting employee stock, or if you just want to combine it with another strategy like a Roth conversion. Depending on how large of a donation you're willing to make, this year may be a particularly great year to cluster your contributions, since the IRS has waived the usual 50% of income deduction limitation for 2021. So typically when you make a cash donation, you're only able to deduct up to 50% of your income that year. And then any excess is carried forward to the next year. But part of the CARES Act was to increase this cap for 2021 to encourage charitable giving. I haven't seen anything to indicate that this is going to be extended for 2022. So make sure your donations are made before year end if you want to take advantage of that. Many people want to take advantage of the clustering strategy, but they feel an obligation to give to a certain organization every year, or they don't want to give it all away at one time. So in this case, using a donor advised fund or a designated fund might be appropriate. In both cases, you receive an immediate tax benefit. The money is then required to be given to a charitable organization at some point, but you can make the donation over time and invest the fund in the meantime so that it grows tax-free. Donor advised funds can also be used when you haven't yet decided which organization you'd like to give to yet, because you don't have to make that indication up front. These funds allow just a ton of flexibility with the amount you donate, where you donate to, and when those donations are made. They can also be a really good conduit vehicle when you have appreciated assets that you want to donate, but several different organizations you want to give to, because it can really simplify the process of donating appreciated stock. The IRS does not allow QCDs from IRA accounts to go into a donor advised fund, but you are permitted to do a QCD to a designated fund. Unlike the donor advised funds, though, designated funds do require predetermined charitable beneficiaries. So they don't give you that flexibility to determine the organization at a later date. For anyone who owns appreciated assets outside of qualified retirement accounts, donating these assets without selling them first can be a great strategy. It's particularly useful for people that have highly concentrated stock positions and want to reduce their risk by selling some of the stock. I think seeing a simple example highlights the tax benefits best. So if an Oregon couple with $200,000 of income has stock that they originally purchased for $10,000, which over the years grows to $50,000, they would have a gain of $40,000, which would be taxable to them if they sold the stock. If they want to donate it to charity, and if they want to donate to charity and then they sell it first, they would owe 15% in federal long-term capital gains taxes, 3.8% in net investment income tax, and 9.9% in state income tax on the sale, which would total about $11,500 in taxes. And that would leave them with about $38,500 that they could donate to a charity, and they would only receive a tax deduction for that amount. However, if they donated the stock without selling it, they would avoid the taxes on the gain. The charity would get the full $50,000, and the full $50,000 could be deducted. I just want to say that with the caveat that deductions can be limited depending on your personal tax situation. The Oregon Cultural Trust is an underutilized resource that can allow you to double your impact when donating to certain Oregon nonprofits. You can go to their website, which is listed here, to see which nonprofits qualify, but I can tell you that EEF is one of them. By making a matching donation of up to $500 per person or $1,000 for joint filers, you will effectively have your match refunded to you in the form of a tax credit when you file your taxes, and that reduces your taxes dollar for dollar. The matched amount is then granted to various nonprofits across Oregon. Okay. I hope this information was useful. The other Sarah will now go over some additional strategies you might want to consider as part of your estate plan. Just one final reminder to make sure you're working with your financial professionals so that you're selecting the best strategy for your particular situation, and also identifying other approaches that might make sense for you in years when you're making larger donations, such as Roth conversions or realizing investment gains in a lower tax bracket. As Dana mentioned, Sarah and I will take some questions after, but if anyone would like to discuss their personal situation one-on-one with me, please feel free to contact me directly. My business card's in the goodie bags that you received. Thank you.
Perfect. Thank you, Sarah. And if you just want to pause on this, I realize I did not have a slide up for my introduction. I'm not that prepared, but I can do it over the Zoom call. So I'm the other Sarah, also known as Sarah Subias. I am an attorney here in Eugene. I also practice in Southern Oregon and out in Sun River. But our firm focuses on general business work, estate planning, litigation, kind of general civil practice. But my bread and butter is I've been an estate planning and administration attorney, read probate attorney, for the last 12 years. So this is what I do day in and day out, is planning and administration. My connection to the foundation is that I'm a parent of two 4J students. So thank you all for all you do. It is super, super helpful to our community. I am originally from the Midwest, but rolled out here for law school. So I'm a law duck. And my disclosure is that although I am an attorney, I cannot give legal advice when we're giving a presentation such as this. Legal advice is taking specific facts, applying the law, and giving a recommendation. I can't do that. I'm happy to answer general questions about the law, about the strategies we're talking about, but I can't take specific facts and apply specific law and give advice. Yes, so my portion of the presentation is about transfers at death, or maybe more nicely said, planned giving strategies to do charitable planning. So thank you, Sarah, for that. My slides. What are the goals of using your estate for planned giving? And the easy one is to save on taxes. And we've got a whole new range of taxes to talk about. Let's talk about estate taxes or death taxes or inheritance taxes, whatever you want to call them. It's the tax on the transfer from a person who's alive at their death to somebody else or some other entity. So we've got two estate tax systems that are all apply to us as Oregon residents. First is the federal estate tax system. It is a 40% tax on assets when they transfer from one person to another. Thankfully, the current exemption amount is $11.7 million per person. However, the newest legislation that we've seen is going to drop that to $6 million. So, you know, it's always a moving target. Oregon estate tax is something that we deal with all the time. It is a transfer tax. The rate starts at 10%, goes up to 16%, and that applies to assets a person owns at their death valued at over $1 million. So collectively, your entire estate, your IRAs, your real property, your bank accounts, all of those things get totaled together. And if your estate is valued at more than $1 million, the amount over that $1 million is taxed at a rate that starts at 10%. It also includes life insurance if you own it or if your estate is the beneficiary. So lots of strategies to minimize estate taxes, but charitable planning is a big one. In estate charitable planning, we're also minimizing income taxes, but that's what the other Sarah talked about. Why am I talking about income taxes? And it's because a deferred tax retirement account, IRA, 401k, 403b, all of those, when they transfer at someone's death to anyone who is not a spouse, so transfer to a friend, a family member, a tax-exempt entity, the requirement to pay those income taxes transfers to that beneficiary as well. So you'll see what we like to do is we like to give income tax payments to people or entities who don't pay income tax, also known as tax-exempt entities. And what is the other big reason for doing charitable planning? And it is legacy planning, doing good things with your assets, making your assets outlast you in helping out your community. All right, switch over. Thank you. Okay, so I'm going to go through 5 strategies that are not all inclusive of everything, but they're just sort of the highlights of how can you put some charitable planning into your estate plan. And the easiest one, number 1, just name the charity as a beneficiary on an asset directly. And that is, for example, bank accounts, investment accounts. You can add a transfer on death or a payable on death beneficiary to those accounts. Real estate, you can either keep yourself a life estate for your life, but at your death, it would pass to the charity. You can do a transfer on death deed. We have those here in Oregon. But the best one, hands down, is if you have charitable intent, name the charity as a beneficiary on your tax deferred accounts and life insurance too, but you don't get quite the tax benefit there. But if you name a charity as a designated beneficiary on your retirement accounts, they're going to receive those assets free of estate tax and free of income tax. Because as a tax-exempt entity, they're not going to pay either. So if you have $1 to give to charity or $1 to give to an individual, give the $1 to charity out of your retirement accounts. They're going to take $1, whereas your beneficiary would take what? 70 cents. This is, something less because there's a tax payment. All right, next slide. The next one, next option for designating charities within your estate plan would be to go through your documents. As Dana mentioned, a lot of people don't have a will. It is fairly simple. You can just do them yourself. I don't recommend it, but then I can't recommend that because I'm an attorney. But having a will, having a revocable trust in place and saying within that planning document, hey, I want this dollar amount, I want this percentage to go to charity. Whoever you've named to be the executor of your estate has to follow those instructions. So, for example, in a will, you say, I want a percentage of my estate to go to the Eugene Education Foundation. Your personal representative, as they're doing the administration of your estate through probate, will have to make a check out to the foundation out of your estate proceeds. If you instead set up a revocable trust, which, as many of you may know, avoids probate, the trustee is also required to make that check out to the foundation out of your revocable trust assets. So either way, you can also include charitable beneficiaries in your will or revocable trust. All right. Now we're going to get fancy. Now we're going to get fancy. And some of these are strategies you can use during your life, but I'm looking at them as death time strategies, meaning that you would be in full control of your assets during your lifetime, and these transfers or these strategies wouldn't occur until someone's death. And the first one is called a testamentary charitable lead trust. That word testamentary just means that it happens at someone's death, as if you've heard of last will and testament. It's a transfer at death. So in a charitable lead trust, let's say you have a charity of choice, for example, the Eugene Education Foundation, and you've got a couple of kids. You could say, I want to give the foundation a percentage or a dollar amount over a set of years, and they're the lead, the charitable lead of the trust, and the remainder of the value of that account is going to transfer to my beneficiaries, my kids, after that lead period has passed. Some of these are what's called a split interest gift. So you're not going to get a full dollar for dollar estate tax deduction, but it's a way to kind of have your cake and eat it too by saying, well, I want to do good here. I want to get some tax deduction here, but I want to also reserve some things going to my children after the distributions to the charities. All right, next slide. So the option, or excuse me, the alternative to that is a testamentary charitable remainder trust. And these are very popular right now. So I'm going to spend a couple of minutes here. And you're going to hear this a lot. We do a lot of planning around retirement accounts. And we do that because of that tax deferred nature of them, right? Like Sarah was saying, every time you pull dollars out of those retirement accounts, you're paying ordinary income tax on it. And so are your beneficiaries. This strategy of a testamentary charitable remainder trust is right now the kind of the hot ticket for what to do if you have a large IRA that you want to leave to a charity, you want to include to a charity, but you also want to be able to stretch the payments, the tax payments of that over a period of time for example, your children. So you have charitable intent, but you also don't want your kids to have to pull all the dollars out of your retirement account within 10 years, which is the new law that came into effect in 2019. So I'll back that up again. If you leave a retirement account to an individual, with some exceptions, of course, that individual will have to fully withdraw your retirement account within 10 years from your date of death. That means they can do it whatever period over that 10 years. It doesn't have to be equal. It could be all in year 1, which could be a problem. It could be all in year 10, which could be a problem. Either way, it has to be fully withdrawn within 10 years, which means within those 10 years, they're paying ordinary income tax on the entirety of that retirement account. Charitable remainder trust allows that payment term to actually stretch out over somebody's life expectancy. So instead of having a 10-year window, you have a lifetime window for your beneficiaries. And at their death, if there's assets left in that account, which actuarially, that's a word, there should be, then whatever's remaining in that would go to the charity of your choice. So this strategy is a really nice way to take an IRA account, get it to your children or your individual beneficiaries over their lifetime. So there's taking a little bit each year and having to pay a little bit of income tax each year, and having the benefit of benefiting a charity down the road that you've put in place. So this is a really good strategy that's become very popular in the last couple of years with the change to the way that inherited IRAs are taxed. All right. And finally, this is my catch-all slide of other things that you can do to make charitable gifts at death. One is along the same lines of a charitable lead trust or a charitable remainder trust. You can do a direct gift, a charitable gift annuity, which means that you contract with a charity to give them some money, and then they're going to return the dollars over time back to you or back to your beneficiary. So you say, I want to do a gift annuity where I'm going to give you X, and you're going to return Y% to a beneficiary I've named over a period of years. As Sarah mentioned, you can set up donor advised funds during your lifetime to direct distributions to charities, but you can also set up a donor advised fund that will receive assets at your death. And either you have a donor agreement that talks about how those funds are to be used, or going back to that legacy planning as part of this, set up family members as the advisors so that they're the ones who say, yeah, I'm going to continue the good work that my family did by giving out these dollars after they've passed to the charities and causes that were most important to them. You can get even fancier and set up your own private foundation. I'm not going to spend much time on that, but you could if you really wanted enough control to how those dollars are being used. And this last one is a trick that I really like, and it's not a legally binding piece, but Sarah had the nice tips and tricks. I'm gonna have this as my one tips and tricks. If Sarah was saying, if you give a charitable gift during your lifetime, there's all kinds of income tax benefits. If you give $1 to somebody at your death, you give them a bequest under your will, and you say, wouldn't it be nice if you turned around and gave these dollars to a tax exempt entity? They would get that income tax benefit. Your estate doesn't get that income tax benefit. So again, you need to talk to your planning professionals about whether or not this is a good strategy. But in some cases, if you don't have an estate tax burden that you're trying to plan around, this can be a nice way to say, I'm going to give you the money with my wish, not a legal requirement, that you turn around and give it to the Eugene Education Foundation. They get a tax benefit. You don't need the estate tax benefit, and the charity benefits as well. So I've seen that done quite a bit, especially as a way to encourage charitable giving, encourage people to start the process of charitable giving and all the good that it does for both the community and the giftor. And so that's my tip and trick in there. That's not something you see typically. And part of all of this, especially with a donor advised fund, a private foundation, these non-binding directions to your beneficiaries are all ways to get your family engaged in gifting, continuing your legacy of support. And it strengthens your legacy, as I said, of giving. I believe that is my last slide. All right, so Dana, back to you.
Thank you both so much for that information. We do have one question in the chat. This is a question for Sarah Kordon from Stacy. Do you have to be a certain age before you can donate a QCD from your IRA?
Yes, so you have to be 70 and a half, which it sounds so funny, but it's 6 months after your 70th birthday. Make sure that you get it right on the nose or later. As I mentioned before, if you have an inherited IRA or a beneficiary IRA, you might be required to take minimum distributions from that account before age 70 and a half, but you still have to wait till 70 and a half. Once you hit that deadline, you can start. If it's not an inherited IRA or a beneficiary IRA, most people choose to wait until age 72 when they're required to start those distributions. But if you're, really charitably inclined and all you have is IRA money, then it might be a good strategy for you to start at 70 and a half.
All right. Do we have any more questions? I don't see any coming through. It was such good information. If you're like me, you might need to chew on it for a little bit. I did mention at the beginning that we are recording this, and as soon as we get over the technological hurdle of figuring out how to download and then upload it, we'll send everybody the link to access it, to review it. Oh, Mary Walston is asking if we can talk about endowments. Is that more of a Sarah Subias question, or is it something both of you can answer?
Depends. That's the question.
She gave the official attorney answer. It depends.
Yeah.
Well, I guess I will say that you know, from an estate planning perspective, endowments are if they're part of a tax exempt entity, then they're a tax exempt contribution. So yes, you can give money to an endowment just as easily as you can give money to the charity directly.
As long as that charity with the endowment is a 501c3 organization, then you should get all the same tax benefits. The Oregon, oh gosh, I'm blanking here. The Oregon Cultural Foundation, OCF, is a great resource if you're thinking about starting your own. And they have a lot of existing endowments that connect with various organizations. So I would encourage anybody who's thinking about doing that and doesn't have a really large sum of money or one organization in mind that has an existing endowment to reach out to them.
And full disclosure, EEF does have an endowment with OCF, in case anyone was wondering or wanted to look into that with us. I also appreciate, Sarah Kordon, that you mentioned the Oregon Cultural Trust. It's really unique to Oregon. And I have the honor of being on the Lane County Cultural Coalition. And so I get to, in a month or so, help distribute the funds that come to Lane County to support art, culture, and I always forget the third one, heritage. Art, culture, and heritage throughout the county. And so that money goes into that account. And then people like me get to help spend it all over their counties or through their tribal organizations. Do we have any more questions? We might actually finish up a little early. Okay, bear with me before we go. I want to show you really quickly. Can you see our website here? So if you are interested in cruising through our website to see how you can give, ways you can give, there's a handy dandy button here. If you want to give stock gifts, we have now a stock form that you can download and fill out and send to us to help with the process. We have the Donate Now button that will take you straight to our Future Funder page. That is a campaign that we have that will be ongoing to help people if they want to donate a lot, but they want to donate over time. It's just a way to do recurring donations. You can also make a one-time donation at this button down here. Then there's district-wide programs you can support. And then if you really want to give to a specific 4J school, there are also pages where you can donate to support those as well. And so that is how you can navigate our page. But as always, if you have any questions, please reach out to us. We are happy to help you out. All right. Well, as long as nobody, one last round for questions while we have these brilliant people. Oh, I see one coming through. Can Sarah Kordon quickly review the extra deductions we can take for charitable deductions, even if we take the standard deduction? I thought I saw a $600 deduction for married filing jointly.
So this is just for 2021. If you are filing individually, you can deduct up to $300 in charitable donations, even if you're taking that standard tax deduction. And if you're filing jointly, you can deduct up to $600. So definitely take advantage of that. If you're thinking about, do I make the contribution in January, do it before the end of the year so that you can get the tax benefit as well.
Wonderful. All right. I think that we have gotten a lot of great information, and I really appreciate Sarah and Merriman and Sarah with Watkinson, Laird, and Rubenstein for joining us today and giving us some really valuable help to learn about some things that can kind of seem complicated when we're trying to figure them out on our own. And so I thank you guys all so much for being here today. Look for an email with the link to this if you want to review the information. Please reach out to us if you have any questions, and I hope you all have a wonderful day.
Thanks, everybody.